So I find that when the markets are in turmoil, as they are right now, one of the best things you could do is look at the wisdom of one of the most legendary investors that's ever been around, the Oracle of Omaha himself, Mr. Warren Buffett. And I found an interview of his from 1985. It's his first televised interview, and we're going to take a look at the principles that he's preaching there, and we're going to see if he stuck to those principles and if they apply to today. And it's such a good time to go ahead and research this because it is a time for us to recalibrate our investment strategy. Over the past 2 years, we were on such a huge bull run that we kind of just threw all the value stuff out the window, all the fundamentals, and we were just chasing the hottest thing that's going to 2x or 3x in the crypto markets or the stock market. However, those days are far behind us. We're going to be in a lull and most likely a recession for quite a while. And this is a great time to go ahead and work on your skill set as an investor. So let's jump right into the video and I'll give my thoughts on it as it rolls.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are. I mean, that if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
All of the great investors always preach this. Mindset, discipline, and patience is absolutely key to having long-term success. Because remember, long-term investors make a lot more money than the swing traders or the day traders. That's been proven through studies time and time again.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. Yeah. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high, but prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
It's so interesting to hear him talk about arcane methods, because if you go ahead and look at the statistics section of, say, Yahoo Finance, you're going to see a lot of arcane metrics there as well. And you also see that the analysts, they're all over the board. And if you take a look 2 years ago versus today, what different industries were trading at different PE values and other metrics, you'll see that some of these are absolutely arcane methods. And a lot of people will argue there are really no great methods or will ever be great methods, because if they were, people spot these inefficiencies in the market and they go ahead and they price it accordingly. Also, he gives such amazing advice, and I've done this myself when I was studying value investing and fundamental analysis, where I would go and I would research everything I could about a company. I would go and I would read the balance sheet, I would read the income statement, cash flow statement, and I would try to predict what the market cap of that exact company is right now. It was fascinating to see my prediction and how it lined up with where it's trading, because it gave me conviction one way or the other. But if you see the price and the market cap and then you go ahead and research, you can be using a lot of confirmation bias when you're seeing should it actually be priced at that price point. So it's a really, really interesting thing. And I actually think it's such a helpful exercise to go ahead, just research a company, maybe one you haven't even heard of. Take a look at the financial statements, take a look at the fundamental and technical analysis, and try to guess what the market cap of that company is. I think you'll be really surprised about how far off you actually are. And it has to do with the macro state of the economy as well. But it's a very, very interesting exercise. Highly recommend it.
So Buffett chose to stay in this world, Omaha, Nebraska, where corn grows just minutes from downtown. Now, Omaha is a nice town, but nobody claims it's a world financial center. Here, the only thundering herd is actually on 4 feet. Don't you find Omaha a little bit off the beaten track for the investment world?
Well, believe it or not, we get mail here, and we get periodicals, and we get all the facts needed to make decisions. And unlike Wall Street, you'll notice we don't have 50 people coming up and whispering in our ear that we should be doing this or that this afternoon.
You appreciate the lack of stimulation here?
I like the lack of stimulation. We get facts, not stimulation here.
How can you stay away from Wall Street?
Well, if I were on Wall Street, I'd probably be a lot poorer. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth, and I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's an intellectual process. And the less static there is in that intellectual process, really the better off you are.
What is the intellectual process?
The intellectual process is defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value, but there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
So you haven't ever owned, for example, IBM?
Never owned IBM. Marvelous company. I mean, a sensational company, but I haven't owned IBM.
And so here is this technological revolution going on, and you're not going to be a participant.
Gone right past me.
Is that all right with you?
It's okay with me.
So when it comes to tech, Warren Buffett actually has changed his stance. Berkshire Hathaway owns a lot of Amazon. They own a lot of Apple and Visa. In fact, Berkshire Hathaway is one of Apple's largest shareholders at $40 billion. Now, what's interesting is there is actually parallels to crypto here. The way he used to talk about tech, he feels that way about Bitcoin. For instance, he's publicly stated that he will never own any Bitcoin. He thinks crypto is a bunch of garbage, and he once called it, and I quote, that Bitcoin is rat poison squared.
I don't have to make money in every game. I mean, I don't know what cocoa beans are going to do. There are all kinds of things I don't know about, and that may be too bad, but why should I know all about them? I haven't worked that hard on them. In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily, and you don't have to make any decisions. You have to make nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, "Swing, you bum!" from the stands, and that's very tough for people to do.
So this actually very much applies to today, because impatience and boredom, they are the kryptonite of the good investor. Because if you take a look at like the actively traded ETFs, like Kathy Wood, she basically ran her ETF into the toilet, and it's not because of the economy, it's because she just keeps trading, and some of it is very illogical and it goes against her own reasoning. So it's very confusing. There's a lot of money managers that they have clients, wealthy clients that gave them money, so they can't just have that money sitting on the side. Then the people will be like, why are we paying you all this money to do nothing? We could keep it in our bank account and do nothing ourselves. And so they're forced to always make moves. Rather than be patient and be calculated, they're forced to go ahead and make moves so they could justify the fees that they charge their clients. TV and YouTube finance gurus are guilty of this as well, because they need to create content. And in order to create content, they need to make moves. They can't just say, okay, for the next 3 months, we should do nothing. Tune in tomorrow so that I could tell you that for the next 2 months and 30 days, you should do nothing. And tune in the day after that, where I'll tell you that for the next 2 months and 29 days, you should do nothing. They can't do that. So they will always be pitching some things, or they're going to go and make risky moves in hopes that they could create new content with it and garner a new audience.
Warren, your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple. That the academics, for example, focus on all kinds of variables. Partly
By
because
academics, you mean professors of
right,
finance?
the data's there.
In business school?
Sure, and the data's there. So they focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off, or if you buy them in election years and sell them in other years, you're better off, or if you buy small companies. There are all these variables because the data are there, and they've learned how to manipulate data. And as a friend of mine says, to a man with a hammer, everything looks like a nail. And once you have these skills, you just are dying to utilize them in some way, but they aren't important. If I were being asked to participate in a business opportunity, would it make any difference to me whether I bought it on a Tuesday or a Saturday or an election year or something? It's not what a businessman thinks about in buying businesses. So why think about it when buying stocks? Because stocks are just pieces of businesses.
So I super appreciate you guys sticking around for the entirety of this video. Let me know if this type of content is something that you want me to keep putting out, because me personally, again, at times like this, recessions, I go back and I look at what the wisest investors, the legendary ones, had to say, what their mantra was, and it goes ahead and it recalibrates my own investment strategy. And so I actually plan to do a lot more research into some of the other sentiments of the legendary investors, and I want to share it with you guys. So let me know if you're interested in it. Let me know who your favorite investor is. If there is a legendary interview that you feel I must cover, let me know in the comment section as well. I appreciate you guys for watching. Remember, don't just pay attention to your portfolio, pay attention to your friendships, relationships, your mental health, your mental sanity, your physical health, and your happiness. I wish you guys nothing but the best. Tune into the next video. It's going to be a good one. See you there.